hello and welcome to Looking at the Markets. I've seen a lot of YouTube videos out there about TSLY, TSLY, which attempts to squeeze more income out of Tesla stock. And people look at that and say, hey, it pays a really high payout ratio, which is like a dividend, right, for TSLY. Or they might look at NVDY, which is kind of like the same thing but for NVIDIA stock, or AMZY, which is like the same thing for Amazon stock. And they've been talking about YieldMax funds and how they have these high dividends or payout ratios, 30, 40, 50% even annually. And so you might think, wow, that's a great way to go. But on the other hand, you're also paying an expense ratio, which is like a fund manager's fee. And it's annualized, and so that's going to eat into your returns. And also, you're not being really totally self-directed, are you? You're just kind of putting it in the hands of other people. And I don't know about you, but I like to have total control, or as much control as possible, over what I'm doing. I'm not just trying to put things in the hands of other people so much. So you have to make your own decisions, do your own due diligence. I cannot tell you what to do, what not to do. It's your money. You're responsible for it. But for me personally, right now, I'm not buying TSLY because I can do it myself. Okay, whatever they're doing, I could do it myself, basically, the same idea at least. And it's really not that hard to do. It's just, let's say, selling covered calls, right? Because these funds are typically using options to squeeze more income, or attempt to, out of these stocks. So let's say TSLY, which tracks, more or less tracks Tesla, but then uses options trading to try to squeeze more income out of it and give you that seemingly big dividend, or payout ratio as they call it. All right, so what if you just did it yourself? What if once a month, let's say, you sold an at the money or close to at the money covered call? So if you can afford to buy 100 shares of Tesla, and I'm using the Schwab website here. Okay, so let's say buy 100 shares of Tesla stock and then sell to open one covered call. And I'm doing it exactly a month out, a month from today's date. And so how much would I get for that? Well, we're looking at right now, let's say I can get $17.40 per share, right? And so if that's 100 shares, I would get $1,740, let's say. All right, so I'm going to type that into my calculator, I'll just type 17.40 per share, and then divide that by the current share price, which is, let's say, 230. Well, we'll go with this one, 236.79. So I divide it, and I would make 7.34% in a month. I would make 7.34%. Basically, instead of a dividend, I'm using a covered call. Some people they consider covered calls to be like a dividend almost. You're paying yourself a dividend. Okay, and so let's say I annualize 7.34% times 12 months. I would be getting 88% per year, 88%. Now let me ask you right now, what does TSLY pay? Does it pay 88%? I don't know what it pays, okay? And there's no guarantee that I'm going to get this amount every month. It's going to change every month, the amount, okay? But also keep in mind, Tesla has gone down recently. And so these covered calls are probably lower than normal. If Tesla stock goes up, then the covered calls would probably pay even more. So if Tesla stock keeps going down, the amount you'll get paid in your covered calls is going to be less. But it just went down, so these are probably pretty cheap comparatively. So you might get more than 88% annualized. I don't know. I'm not predicting the future. But even after a down month for Tesla stock, if I'm going to get 88% annualized, that's pretty good. That's not bad. Now, you won't participate in the upside of Tesla stock if you do this, because you're selling at the money covered calls. And you might have your stock called away, your 100 shares. Okay, but you're just you can rinse and repeat this every month. Wherever the current share price of Tesla is, you can sell an at the money call. Again, I'm not recommending that you do this. You have to make your own decisions. But that's pretty good, and you're not paying an expense ratio, you know, like a fee to some manager, some fund managers. So you pocket that, whatever you would have spent that on, whatever you would have paid for that. And if you could find a low cost or no cost broker, even better. Then you won't be paying a lot of fees and commissions. You know, selling the covered call, buying the 100 shares of stock. Let's take a look at NVIDIA. Okay, it's NVDY for the fund that does it for you. But what about but they also charge you an expense ratio. What about just NVIDIA stock? Let's take a look. We go to the covered call strategy here in Schwab or whatever you're using. Okay, so again, I'm going to go a month out, exactly a month. And I'm going to make it, you know, it doesn't have to be exactly at the money. You know, if it's $1 or $2 this way or that way, it's not the end of the world, okay? So let's say I can buy 100 shares right now at 421 and then sell a covered call at, I'm going to go at this mid price, let's say, okay? You're not always going to get the mid price. Usually you can probably get pretty close to it though. So $22.35, which would be $2,235, you know, because it's 100 shares, right? Divided by, let's say 4. Let's go at this price. Copy and paste it. Let's be exact, right? 421.43 for the share price. That would be 5.3% in a month, okay, for selling that at the money approximately call there. And again, NVIDIA has gone down quite a bit recently. Not quite a bit, but it's gone down recently. Tech stocks generally and the NASDAQ generally has gone down over the past month. So, you know, in the future, I might get more than 5.3% in a month, but that's just what I would get in a month for this one. And then annualized times 12 months, that would be 63, almost 64%. Not too bad, okay? 63 or 64% annualized, and I'm not paying any fees here to any managers, any fund managers for doing this. So that's really not too bad. What about AMZY? Okay, well that generally tracks Amazon stock, but attempts to pay a dividend or payout ratio on that. Again, let's practice here. Covered call strategy, buy 100 shares and then go a month out and go approximately at the money, give or take a few cents here or there. Let's say $6.10 per share, so 6.10 divided by the current share price, and I'm just showing you how I do it, equals, I would get 4.8% in a month, not too bad, annualized. And again, Amazon stock, it's gone down recently. Tech stocks have generally gone down. So I would get 58% per year if that's annualized. Not too bad, right? No guarantee that I would get that in a year because it would change every month. But still, 58% in a year. What does AMZY pay? Compare it and then subtract out the expense ratio. And what would AMZY really pay you? Okay, so you can do this yourself. Now, what if you think the stock is going to go up? Okay, so you can change the strike price to something higher, right? You can go to 135 or 130 or 140, whatever. All right, and then you wouldn't get paid as much with the covered call, but then if Amazon stock goes up, then you get some share price appreciation there. No guarantee, of course, Amazon stock could go down, but why not pay yourself instead of counting on some fund managers to pay you and allow them to decide? I like to have control over my self-directed account, and I'd like to think maybe you do as well, and this is just a really simple way to be a do-it-yourselfer, okay? So it's just something to think about. I really like this strategy. Just maybe you can paper trade it with a virtual account. If you're thinking about doing it with real money, be really careful and do your research first. and use small amounts of money, which is hard to do because buying 100 shares of stock is not so easy. Okay, so maybe the strategy is not for you if you'll end up losing a lot of money if this doesn't work out. So always think about the downside possibilities. All right, this is Looking at the Markets. I hope this was helpful to you, and hopefully more videos are coming soon. Thanks a lot.